3 decades of careful distance between the planet's 2 largest economies dissolved this week when synchronized intervention of historic magnitude slammed into the foreign exchange arena. What took place was the single largest one-day currency defense operation ever documented, launched by Tokyo and then joined by Washington in a partnership last observed nearly 30 years earlier. Roughly $53 billion surged into purchases of the Japanese currency within a solitary session, after which the United States entered the identical market through official channels for the first time in a generation. The consequences arrived with startling speed. Inside 40 minutes, nearly $1 trillion evaporated from American equity valuations, while on the opposite side of the Pacific, a major Asian share index suffered its most punishing monthly decline in recorded history, exceeding the depths of the global financial crisis and the regional upheaval of the late 1990s. These occurrences were never disconnected episodes. They formed successive pressure releases along one continuous and largely concealed financing architecture that has underpinned asset prices for years, and recognition of that architecture now distinguishes safeguarded capital from exposed capital as later phases develop. For many months, the Japanese currency had been depreciating without pause, eventually reaching valuations last witnessed 4 decades earlier. Each successive unit acquired fewer and fewer dollars, steadily diminishing domestic purchasing power and demonstrating how national savings can drain from an economy. On a decisive Thursday, the authorities concluded that further depreciation could no longer be permitted. They committed approximately $53 billion in concentrated acquisition of their own currency, establishing a fresh benchmark for the scale of any single-day intervention. The subsequent development that few anticipated was the parallel participation of the United States. Official channels commenced purchases of the same currency, an action whose closest precedent stretched back to coordinated efforts following a major natural catastrophe more than a decade earlier, and whose prior joint defense of that currency itself dated almost 3 decades into the past. Such infrequent collaboration inside markets, ordinarily characterized as free-floating, rarely materializes without underlying strain of substantial magnitude. Within the same span of days, a photograph captured during an official gathering disclosed handwritten notations outlining preparations for further purchases measured in the billions. Market reporting shortly confirmed that additional support was under consideration. Equity indexes that had registered modest advances earlier in the session reversed with abrupt intensity. Gains of roughly 0.7% transformed into declines surpassing 1%, extinguishing nearly $1 trillion of capitalization inside 40 minutes. The velocity and breadth of the reversal invited an unavoidable question. Why should developments centered upon a single Asian currency trigger so rapid and sizable a reaction across American share prices? The answer resides in a financing structure that remains unfamiliar to most outside professional circles, yet has quietly financed a considerable fraction of global asset accumulation across many years. That structure is known as the carry trade. Across an extended interval, Japan maintained interest rates at or extremely near zero. Large institutional participants could therefore borrow the currency at essentially negligible cost, convert the proceeds into dollars, and deploy those dollars into higher yielding American instruments encompassing equities and government securities. The differential between the near zero funding rate and the returns earned on the invested capital generated consistent profits, provided one critical condition endured. The borrowed currency had to remain weak or at least stable. Because ultimate repayment took place in that same currency, any continued depreciation lessened the real repayment obligation. The arrangement functioned as an inexpensive and expandable source of leverage that supported demand across multiple asset classes at once. When the currency strengthened abruptly, the arithmetic inverted. The identical loan that had appeared inexpensive became materially more costly in local terms. Positions that had seemed comfortably profitable confronted margin pressure. Participants were compelled to raise liquidity with urgency, and the most readily accessible avenue for doing so proved to be the disposal of American equities. Simultaneous exits from the same concentrated trades produced the intense selling observed during those 40 minutes. The official action that lifted the Japanese currency only modestly from the mid-160s into the mid-150s proved sufficient nonetheless to force a visible portion of that leverage to unwind. Market observers noted that should the currency continue appreciating toward levels approaching 140 or lower, the volume of forced liquidation could enlarge further, potentially elevating funding costs throughout dollar-denominated markets and intensifying pressure upon equity valuations. The decision by American authorities to participate arose not from abstract affinity. Japan continues to rank as the largest overseas creditor of United States government obligations. When a nation deploys tens of billions within a single day to defend its currency, the necessary resources must originate somewhere. One readily available reservoir consists of foreign exchange reserves, a sizable share of which is held in American treasuries. Extensive disposal of those holdings by the foremost foreign creditor would exert upward force upon yields. Elevated yields increase the expense of servicing a national debt quantified in the tens of trillions, tighten broader financial conditions, and transmit effects into asset prices and economic activity. Coordinated support for the currency therefore operated as a mechanism for containing the risk that rapid depreciation would compel precisely such disposals and thereby amplify domestic pressures. Asia registered the strain at the earliest stage. During July, the principal equity index of South Korea recorded its steepest monthly decline in history, exceeding 30%. That contraction outstripped the losses recorded during the global financial crisis and those experienced amid the regional disruptions of the late 1990s. Trading was suspended on consecutive sessions under emergency protocols never previously activated. Although sector-specific elements involving technology and leverage speculation contributed, the overarching pattern replicated the identical sequence of inexpensive borrowed capital inundating favored assets only to reverse abruptly once funding conditions altered. Smaller and more responsive markets frequently disclose the initial phases of an unwind before the consequences fully arrive at larger centers. The succession of events therefore composes a coherent continuum. Extended weakness in the Japanese currency facilitated an enormous volume of leveraged positioning. Official endeavors to reverse that weakness, first unilaterally and subsequently in coordination, activated margin pressure and accelerated deleveraging. Equity markets absorbed the consequent sales, while the prospective necessity for Japan to liquidate dollar reserves underscored the interlinkage among currency defense, sovereign debt markets, and asset valuations. The limited extent of the initial currency adjustment relative to the market reaction implied that additional appreciation could generate further disorderly adjustments. For those allocating capital, the operative implication is not precise forecasting of the subsequent movement in exchange rates, but acknowledgement that the funding structure supporting numerous asset prices has entered a phase of strain. Positioning that depends upon continued currency weakness and inexpensive leverage confronts heightened vulnerability. Assets that have historically demonstrated resilience when confidence in paper currencies diminishes or when systemic leverage contracts tend to furnish relative stability. Among those stand tangible stores of value whose supply remains constrained and whose demand frequently intensifies when uncertainty expands. Precious metals, above all gold and silver, have fulfilled this function across extended historical intervals. Their valuations respond to alterations in real interest rates, currency confidence, and the search for assets situated outside the conventional credit apparatus. When funding markets constrict and equity volatility ascends, allocation towards such metals can supply a counterweight that does not rely upon the persistence of any particular carry arrangement. Quality real estate of enduring character and equity participations in enterprises that possess authentic pricing power can likewise contribute to resilience, provided those holdings rest upon comprehensible commercial foundations rather than speculative narratives. Infrastructure-related enterprises that enable commerce, irrespective of which technology cycle predominates, often exhibit more consistent cash generation than pure growth narratives financed predominantly by leverage. The governing principle remains clarity. If the economic logic supporting an investment cannot be articulated with precision and brevity, the position is more likely to prove fragile amid abrupt shifts in funding conditions. Balances of cash beyond a prudent emergency reserve steadily forfeit purchasing power under inflationary pressure and therefore constitute an inferior long-term repository. Diversification to assets whose value depends less upon the uninterrupted availability of inexpensive credit diminishes exposure to the identical mechanism that has just exhibited its capacity for rapid contraction. The events of recent days do not represent an isolated currency episode. They disclose the sensitivity of global markets to the unwind of a trade that has operated largely beyond public scrutiny for years. The magnitude of official intervention required to produce even a limited currency recovery, combined with the rapidity of the equity reaction, indicates that the underlying positions remain substantial. Looking forward, the trajectory of the Japanese currency will continue to shape funding costs and risk appetite. Additional official support or market-driven appreciation would examine the residual leverage still embedded within portfolios. Conversely, any renewed weakening might temporarily alleviate pressure, yet leave the structural imbalance intact. In either circumstance, the conclusion remains identical. Capital concentrated in assets whose valuations have been sustained by the availability of near zero-cost borrowing confronts the prospect of abrupt revaluation when that borrowing grows more expensive. Assets that reside outside that funding channel, including monetary metals with established records as repositories of value, occupy a distinct position upon the spectrum of resilience. Gold in particular has served for centuries as a monetary anchor whose purchasing power has endured through successive monetary regimes. Its limited annual supply growth relative to expanding global credit, combined with its independence from any single issuer's balance sheet, renders it responsive to periods in which confidence in fiat arrangements wavers. Silver, while possessing significant industrial applications, retains a monetary dimension that historically amplifies during intervals of financial stress. Both metals therefore function less as speculative instruments and more as structural components within a diversified allocation designed to withstand the contraction of leverage-dependent valuations. The week just concluded delivered three concurrent developments that seldom coincide. Historic intervention within the foreign exchange market, a sudden multi-hundred billion-dollar equity contraction measured in minutes, and a record monthly collapse within a major Asian index. Viewed collectively, they illuminate the transmission of stress from currency markets through leveraged positions into broader asset prices. For those attentive to the implications, the interval ahead presents an occasion to reassess exposure and to emphasize holdings whose performance depends less upon the continuation of an extraordinary funding environment. Gold and silver, as traditional monetary anchors, remain central to that reassessment. Their function is not speculative but structural, furnishing a form of insurance against the conditions that the recent intervention sought to restrain. The financing apparatus that supported years of asset appreciation has displayed a visible fracture. Positioning in recognition of that reality constitutes a matter of prudence rather than prediction. Historical precedent reinforces the significance of the present moment. Previous episodes of coordinated currency support have frequently preceded extended periods of adjustment within interest rate markets and equity valuations. The scale of the current intervention, occurring against a backdrop of elevated global debt levels and persistent inflationary pressures, amplifies the potential transmission channels. When the largest overseas holder of sovereign obligations contemplates the liquidation of reserves to defend its currency, the secondary effects upon yields and risk assets become difficult to contain within national borders. The simultaneous stress observed in Asian equity markets further illustrates how regional leverage can serve as an early indicator of broader deleveraging dynamics. Within the precious metals complex, the implications are correspondingly direct. Periods characterized by rising real yields or abrupt equity corrections have historically produced divergent short-term price behavior in gold and silver, yet the longer-term demand for monetary metals has tended to strengthen whenever systemic leverage contracts. Central bank accumulation of gold reserves over recent years has already altered the supply-demand balance, reducing the quantity available for private investment and thereby elevating the sensitivity of prices to incremental demand. Silver, with its dual monetary and industrial character, often exhibits greater volatility, yet also greater percentage appreciation during sustained periods of monetary uncertainty. Allocation decisions that incorporate these metals therefore rest upon their capacity to preserve purchasing power when conventional financial assets confront simultaneous pressure from rising funding costs and forced liquidation. The interconnected nature of the carry trade, sovereign debt markets, and equity valuations ensures that adjustments seldom remain confined to a single domain. A strengthening Japanese currency elevates the local cost of outstanding yen-denominated liabilities, prompting sales of dollar assets and potential upward pressure on American yields. Higher yields increase the debt service burden of the largest borrower in the system, which in turn can constrain fiscal flexibility and elevate risk premiums across asset classes. Precious metals, being free of counterparty obligations and independent of any single currency's trajectory, occupy a distinct category within this transmission process. Their historical performance during intervals of monetary realignment has frequently reflected the search for assets whose value is not contingent upon the uninterrupted expansion of credit. Observers monitoring the evolution of these dynamics will note that the modest currency movement achieved by the recent intervention already generated measurable market disruption. The residual volume of positions still dependent upon continued weakness in the Japanese currency remains substantial. Any further appreciation would test the capacity of those positions to unwind in an orderly manner. Conversely, a return to depreciation would merely postpone the reckoning while potentially enlarging the eventual adjustment. In either scenario, the prudent response centers upon reducing reliance upon the very funding conditions that have just demonstrated their fragility. Assets that derive their value from scarcity, durability, and independence from credit markets, foremost among them gold and silver, provide a structural counterbalance. The narrative that has unfolded across these days therefore extends beyond any single currency or equity index. It encompasses the architecture of global leverage, the interdependencies among major economies, and the differential resilience of various asset classes when that leverage contracts. Capital that remains heavily concentrated in instruments whose prices have been supported by inexpensive yen funding faces elevated vulnerability. Capital that incorporates monetary metals and other real assets whose performance is less dependent upon the persistence of extraordinary monetary conditions occupies a more secure position. The fracture that appeared this week is unlikely to close without further adjustment. Positioning in recognition of that reality constitutes the practical response available to those who observe the sequence of events with clarity. Further examination of the carry trade reveals additional layers of scale and complexity. The volume of yen-denominated borrowing that has financed dollar asset purchases over successive years is measured in the hundreds of billions. When even a fraction of that stock is compelled to reverse, the resulting sales cascade through the most liquid markets first. Equities, being continuously priced and readily transferable, absorb the initial wave. Government securities may experience secondary effects if reserve managers are forced to raise cash by disposing of treasuries. The feedback into yields then elevates the cost of capital for governments, corporations, and households simultaneously. In such an environment, the relative stability of gold and silver becomes more pronounced. Because neither metal relies upon ongoing credit expansion for its fundamental value, their prices may fluctuate in the short term as liquidity is sought across all asset classes, yet their longer-term trajectory has historically reflected the cumulative effects of monetary stress rather than the temporary availability of leverage. The role of Asia as an early warning system deserves additional attention. Smaller markets with thinner liquidity and higher concentrations of leveraged participants often register the initial stages of an unwind with greater intensity. The record monthly decline in the South Korean equity market, accompanied by consecutive trading halts, illustrated how rapidly positions can be liquidated when funding conditions shift. That episode preceded the more visible reaction in American equities by only a short interval, underscoring the interconnectedness of regional and global leverage. When the same pattern of inexpensive borrowed capital flooding into favored assets and then rushing for the exit appears across multiple jurisdictions within the same week, the probability that the episodes are coincidental diminishes sharply. Official statements and market reporting have confirmed the sequence of intervention, the scale of purchases, and the subsequent market reaction. The photographic evidence of preparatory notations, the subsequent news flow, and the price action itself form a consistent record. The carry trade, long operating in the background, has been forced into the foreground by the sudden strength of the currency that underpins it. The modest size of the currency recovery relative to the magnitude of the equity response suggests that the remaining positions are still sizable. Continued appreciation would test the orderly capacity of those positions to reverse. A return to depreciation would only defer the adjustment while potentially increasing its eventual scale. In this setting, the structural attributes of gold and silver assume heightened relevance. Gold's limited mine supply growth, typically around 1 to 2% annually, contrasts with the far more rapid expansion of global credit aggregates. Its status as a non-liability asset free from counterparty risk further distinguishes it from instruments whose value depends upon the solvency of issuers or the continuity of funding markets. Silver combines monetary characteristics with substantial industrial demand, creating a dual sensitivity that often produces amplified price movements during periods of monetary uncertainty. Both metals have served as stores of value across centuries of monetary experimentation, currency reforms, and episodes of leverage contraction. Their inclusion within a broader allocation therefore rests upon historical precedent rather than short-term speculation. The transmission channels from currency intervention to sovereign debt markets to equity valuations and finally to real asset demand form a continuous loop. A stronger Japanese currency raises the local cost of yen liabilities, prompting sales of dollar assets. Those sales can pressure equity prices, and if reserve managers participate, elevate treasury yields. Higher yields increase the debt service burden of the largest sovereign borrower, which can constrain fiscal options and elevate risk premiums. In such conditions, the demand for assets independent of any single currency's trajectory tends to increase. Gold and silver, by virtue of their monetary heritage and physical scarcity, occupy a natural position within that demand shift. The events of the past week have rendered visible a financing structure that had previously operated with limited public scrutiny. The largest one-day currency intervention on record, the coordinated participation of the United States after a 3-decade absence, the rapid evaporation of nearly $1 trillion in equity value, and the record monthly decline in a major Asian market together constitute a coherent signal. The carry trade that has supported asset prices for years has begun to unwind under the pressure of currency strength. The residual scale of that trade remains substantial. Further currency appreciation would intensify the adjustment. A temporary reversal would only postpone it. In either case, the differential resilience of various asset classes becomes the practical consideration. Assets whose valuations have been sustained by inexpensive yen funding face elevated vulnerability. Assets whose value derives from scarcity, durability, and independence from credit markets, particularly gold and silver, provide a structural counterbalance. The fracture that appeared this week is unlikely to seal without additional movement. Recognition of that reality and the corresponding adjustment of exposure constitute the measured response available to those who examine the sequence